Hi, everyone. Welcome to the Timing Research Show for December 7th, 2015. Today we will be talking about the 115th weekly report from Timing Research. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com /reports, and you can download this or any report there. My name is David Kosmeter, and I'm the creator of Timing Research, but I have Dave Landry of DaveLandry.com hosting for me again. He's returning after about 2 months break, I think.
Yeah, took a little break.
So I'm going to go ahead and turn over the show to him.
Okay, thank you, David Kosmeter, for having me back on. I appreciate it, and thanks to Timing Research also for having me here. Dean, let's go to you. Dean Jenkins of FollowMeTrades.com. Tell us a little bit about your trading, and tell us a little bit about your website, FollowMeTrades.com.
Yeah, you bet. And, thanks for inviting me to be here. This is pretty cool. This is a new venue, and I'm looking forward to it. So I'm Dean Jenkins. I'm the founder of FollowMeTrades.com, and I am a technical trader. You know, I like to say tongue-in-cheek that some of the finest fiction written in our modern era is a corporate earnings statement. Say that a little bit tongue-in-cheek, you know. But of course, all according to GAAP rules, right? So I believe that all that information matters, but that it's all reflected in really the only realities of the market, and that's price and volume. Those are the indisputable realities. And I think the price pattern tells a story, and there's some, you know, when certain patterns form, you can begin to assign some high probabilities to what's going to happen next. So I trade using Dow theory, Elliott wave, very simplified versions of those, and try and catch, you know, impulsive waves.
Cool. All right, Neil, let's go to you. Neil is a veteran of the show, but some of us out there, I guess, don't know you. Tell us a little bit about your trading, Neil Batho of TradeReview.com.
Sure. I'll trade the trends. I use technical analysis, and I'll use top-down analysis. A lot of people aren't sure what that is. Top-down is when you look at the overall economy, how things are going, and then you make your analysis from the top down to the individual stocks. Bottom-up analysis is where people say, to hell with everything, I'm only going to look at the company itself. And that doesn't work, because if oil's going down, I don't care what oil company you have, oil's going to go down. If tech's going up, you could start a company in your basement called Tech's RS, and it's going to go up. So I'll trade the trends based on point and figure charting mostly. I'll use the Ichimoku cloud as well, put them together, and some very interesting indicators that I learned many years ago called the bullish percent and a few other that I'll use to time the overall risk in the market, because I believe a lot of people think if the market is risky, that's when you make the most money, but I believe you make the most money when it's the least risky, and you can determine the risk and make the trades and stay in the trend as long as you can.
Cool. Okay, next up we have Jim Kinney of OptionProfessor.com. Jim's a veteran of the show, but for those of us who don't, easy for me to say, it's been a while, hasn't it? For those of us who don't know you, Jim, tell us a little bit about yourself and a little bit about your trading.
Sure, Dave. The role that I play at OptionProfessor.com, and what OptionProfessor.com does is they perform an educational service to all the different traders out there on the uses and risks of all the different type strategies that are discussed, from buying the options to writing them to doing spread transactions and all different types of combination tactics, and try to educate the traders on the uses and the risks of all these different type strategies, so they know, you know, what they're doing and the use and the risk of the tactics. So basically, I'm the content provider for the Option Professor, and I've done that for many, many years.
Cool. As I often say, a lot of moving parts when it comes to options, so education is certainly welcome there. Okay, I'm Dave Landry from DaveLandry.com. For those of you who don't know me, I've been trading for a long time. I've written 3 books on trading, which have been published in several different languages, I think, last time I counted. And I believe that you can only predict the short term when it comes to markets. However, you could stick around longer term if the trend begins to resume or emerge in the case of emerging trend type of patterns. Anyway, I have a 21-page report on that on my website. and the free reports. If you go to products or go to store, you can get that off the free section of the site, and that explains a lot about the methodology. And the rest is just it's just pretty much details. Okay, and then like Neil, you use a little fundamentals, don't you?
No, not really. I can look at some unique circumstances from time to time, but not really.
Okay. Okay, I was worried that yeah, because I didn't mean to say the F word, but I think that everyone here is a pure technician. Okay, with maybe some tiny minor exceptions on your part. Okay, let's go to you, Dean, and the question this week, two-part question, and that's question 2 and 3 on your sheet. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower from today's open to the close of Friday, and that's December 11th?
Yeah, so I'm in agreement with the report that I think it's going down. I think we could get down to 2040 or below on the S&P, and I give that about a 75% probability.
Okay. Okay, and then obviously in the next question we'll flesh out that prediction a little bit. Okay, let's go over to excuse me, I'm trying to move computers here. Let's go over to you, Neil. Based on any technical fundamental indicators you want to use, would you predict that the S&P 500 to be higher or lower? And then after you make your prediction, rate your confidence to that by estimating the probability you've correctly predicted next week's market move.
Yeah, down. I'd say 90%.
90%. Wow.
Well,
Okay.
I'll put in a tiny caveat there, Dave. If the market is down every single day this week and it's down Friday morning, you usually get this thing called the 2:30 turn or the 2 o'clock turn Eastern. So
Yeah.
if you are right on it, you're right there at your computer, you get out of your shorts at that time, and you could buy a call or do some futures and make 100% in an hour. So that's something to really, really watch for.
So
I've seen it happen a million times.
Yeah, they used to watch for that daily. Some of the day traders. I'm just not a big fan of day trading, but you see that on a daily chart too? I mean, like on a Monday, Tuesday, Wednesday?
No, I don't look at it for those days, but only if things are looking really bad, looking bearish, and stocks are down every single day during the week. Friday, all the shorts freak out an hour before the close.
I wonder, I don't know if the implieds would be too high. Maybe Jim could chime in on this. I'm wondering if there'd be like a gamma situation where you could pick up some really cheap, very short dated options. Jim, any thoughts on that?
Well, they do have options, I know, on a weekly basis, so I guess you could do something on a short-term weekly if you wanted to play it that way.
Yeah.
But did you want me to segue into?
Yeah. Go ahead. Since we have you up or down, and then rate your confidence.
You know, obviously this is just abject guessing here on everybody's part because we don't have crystal balls. But I will say that the 200-day moving average on the SPX is at 2064. Today's low is 2066. It did move away from the low going into the close. So I'm going to say, as a guess, that it's going to rise this week, and I will give it a very high probability unless we do take out the 2064, 2066 that was established here today, and the VIX jumps well above 17. So we don't get a VIX well above 17, and we don't get the S&P taking out today's lows, then I would say it was going to rise. And so without that, you know, obviously since there's a caveat down there, probably 60-40 would be the way I'd look at it.
Okay.
Looking for turnaround Tuesday, possibly. You know.
Oh, I got you. Okay. Well, I'm not going to, well, I'll disagree with you, and I'm going to agree with Dean and Neil, and I'll flesh these out in the next question. But I think because we have a major sell signal going back to last September, or September, I should say, I think so far, I think the market's still in trouble. And as a trend follower, the market would actually have to make new highs and stay there before we get too excited about the market. But I think at this juncture, and then this is going to kind of dovetail into the question later on, given the market's been so choppy, I think it's a crapshoot at best. And also, the indices are much more efficient than individual stocks and individual issues, and I think it's a little easier to predict an individual stock. I don't want to give away my complete answer for the question of the week. But with that said, I think predicting indices is much harder than individual issues. But in this particular case, I think until we get to new highs, I'm going to stay cautious and maybe even slightly bearish in here. And I'll give it a confidence of 60%. Okay, speaking of question of the week, Dean, let's go back to you. And the question of the week is, let me get to it, make sure I read it right. Okay, which asset type, and they could be stocks, options, forex, futures, etc., do you think is easiest to trade profitably, and why do you think it is the easiest?
Yeah, I think picking moves on stocks is the easiest for me. I typically trade them with options if there's a good option market for the chart I'm looking at. But I certainly look at the sector. I look at the overall market trend. But the pattern that I'm looking for on stock charts, I think it's easier because there's way more to go look at than there are indexes, and I can go look through a couple dozen charts and find one that meet my criteria really, really well, where you're kind of stuck with the indexes and you got to wait for a pattern to perform.
Amen on that. In fact, I'm going to use that part of that in my answer. I actually skipped the question. My apologies. Boy, I tell you, get out of routine. Question one, which is actually the third one I asked, which is a little confusing. So while we have you, let's go ahead and have you answer that. The question is, what developing events, they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah, I'll go ahead and show a quick chart here if I can.
Absolutely, yeah. This is where we like to show charts. Please do.
Yeah, so I've got the S&P, the E-mini up here on a 60-minute chart. And again, I'm a technical trader. I'm paying attention to the to the economic environment and the news and stuff, but I'm making all my decisions based on this chart. And what I see forming right now on the 60-minute that gives me that bearish prediction for this week is a pretty classic Elliott wave, 1 and 2 completed with the potential of a 3 starting. So we were in a pretty tight range up to last Wednesday, and then Wednesday we had a pullback. Thursday it went down pretty dramatically.
What's that leg on Thursday?
So this all Wednesday, Thursday is a wave 1 to me, and then Friday's pull up was a 2, and so our next move could be a 3 down, and that could be pretty dramatic.
Oh, so, okay, cool.
I'm looking at Dow theory. I look for lower lows, lower highs, and so we pulled up a little bit late today, but that could just be a lower high, and then tomorrow take back off down. We'll have to see, but that's what I'm basing it on.
Dow theory on an hourly basis?
Well, I think it applies to any time frame.
Really?
It applies to any time frame, yeah. So it's really just, the Dow is, the Dow theory, the simple part says, an uptrend is higher highs, higher lows. The downtrend is lower lows, lower highs. And until that pattern's broken, that wave is continuing. I just apply that theory to Elliott waves to see when we're in an impulsive or a corrective wave.
Dean, were you recently in Germany?
No.
No, because they were talking about somebody in Germany that was using a Dow theory on an hourly chart. It sounds a lot like what you're doing here. So, interesting.
No. Cool. I'll go.
Yeah.
Somebody sends me a ticket, I'm there.
Yeah, amen. The beer's good. I could attest to that. Yeah. Okay, Neil, let's go over to you. I'm sorry. Do you have anything else to add on that, Dean? I might have cut you off.
No, that's good.
All right, fantastic. And we'll come back to you for some closing thoughts in a few minutes. Neil, let's go to you. What developing events, technical or fundamental, will you be watching out for during the trading week, December 7 to 11, that's this week, obviously, that might have a positive or negative impact on the S&P 500 and other U.S. markets?
I guess we're going to go back to the main indicator that I use, which is the bullish percent index, and I'm going to bring that up here. Just a second. The bullish percent will determine what stocks within the S&P 500 are on buy sells or buy signals. So I'm just hold on a sec.
And what's while you're pulling that up, if you could tell us what does a buy signal mean in this particular indicator?
Okay, a buy signal doesn't necessarily mean you're going to buy the stock, but what it means is that in the near term, it's broken out past. It's made at least a double top breakout, triple top breakout. So in the near term, like let's say a daily chart, it would be on a buy signal. So it doesn't mean the chart is terrible, but it means there's some sort of upward momentum there.
Now, is that on a point and figure chart?
It is on a point and figure chart. It'll often be the same on a candlestick chart. They'll often correspond pretty well. So I'm just going to Okay. Did this come? This is up now?
Yeah, yeah.
Okay, so what you'll see here is over here on the right-hand side. If you don't read point and figure, it's looks a little bit like hieroglyphics, but you'll see that the scale is from, well, it's actually from 0 to 100. It just shows 20 because it hasn't been below 20. But this B is November, and so it reached 72. So 72% of stocks in the S&P 500 were on a near-term buy signal. You can see back here it peaks in the high 80s. And so now we're down at 64%. So when this reverses about 6%, you'll see sort of this cascading effect of sell signals coming onto the market within the index. And so that tells me it's going to be really hard to reverse. And this actually reversed 3 O's over a week ago. So you could see some weakness in the market. And so that's like the big indicator that I use.
Wow, that's pretty cool. And you could get that on stockcharts.com from the looks of it, huh?
Yeah, it's amazing what you can get on stockcharts.com. So
yeah,
you just type in the word bullish, and you can not only get a bullish percent for the S&P 500, but you can get it for the energy sector, the oil sector. And oil was at 0 a couple months ago.
Wow.
0. Not one single stock in all of oil was on a buy signal. And so when that reverses 6%, you got to say to yourself, okay, the risk-reward factor is looking pretty good to me now. And we made some great trades on oil when that happened. So the bullish percent to me is the best indicator you can get.
Is there some are there some parameters you can set on that, or is it automatically built into to the chart?
It's actually, you can go scroll down here and you can say box size 2.
Okay.
You can change it to box size 1, which would mean that it would change if there was a 3% reversal. But what I find is you get a lot of bad signals doing that. You just stick with the 2%.
Yeah, a little noisier. That's really cool.
Yeah.
Thanks for sharing that. I think that's a really useful information. I'm definitely going to play around with that a little bit. Okay. Anything else, Neil, before we go over to Jim?
Nope, that's it.
All right, cool. Good stuff, man. I appreciate that. Jim, let's go over to you. What developing events, technical fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah. Well, the two things that I think are worth looking at as far as the markets are concerned is Europe and the price of oil. The ECB cut their rates last week, trying to penalize banks for parking money. They extended their QE to March of 2017 at $60 billion a month, and they're now going to include regional debt as opposed to government debt, and they plan to reinvest, whatever that word reinvest means. That when this phantom debt that they're creating comes due, they're going to roll it over into new debt. So it looks like that game might be extended for months or years. Now, when this all came out, it obviously was not taken very well. I don't know if you were in Germany when it happened, Dave. Were you in Germany?
I ignore the news, so I'm sure I was.
Just thinking, if you had a ticker, it was down 5% on the DAX, so I assume there was some red signs going across the tape, right?
Yeah, yeah.
So obviously they hit Germany pretty hard. They hit French pretty hard after this announcement, and then today they bounced back up just a little bit, and it'll be very interesting to see if they go into the big fade mode, because if they do, obviously it could drag the S&P down with it very easily. Price of oil down at 37.75. Obviously that's something to keep an eye on. To give you an idea, Kinder Morgan stock traded like 110, 120 million shares today. That's about 10 times what it normally does.
Wow.
And so they're coming out of these oils, in some cases like a fire department showed up. So the bottom line is that these are things you got to keep an eye on. And the indexes, I don't know if you people are following moving averages, but they're just being violated on both sides with regularity. So in that environment where they're violating the averages back and forth, it's hard to make any good statements. Dave said something about a closes above 2135, the all-time high in the S&P, and then you could maybe feel more comfortable being long. I agree with that 100%. And then, of course, closes under 2040 and 2000. with the VIX jumping way above 17, could cause another acceleration to the downside. So we're kind of in no man's land when you're talking 2060, because again, it is above some of the moving averages.
Yeah.
But I'm also looking at the broad-based indexes, the KNIFE, NYA, and the Russell, and those things are way off their all-time highs, and they've had a very difficult time getting any gas in their engine, and they are a much wider scope on stocks than the S&P or the NASDAQ. So, basically, I'll be looking to see how this price of oil unwinds, and I'll be seeing if Europe has a bid in it the rest of the week, or if they're going to start, folding like a lawn chair.
Well, you talked about that moving average getting violated from both sides. I want to remind you, we want to keep the show PG-13. So I think I'm up next. And what I was talking about as far as a sell signal is when you have an all-time high, and sometimes even a multi-year high can work quite well, but especially an all-time high like we had in the S&P 500 recently or over the summer. And then you have the moving average crossing. I use a 10-day simple, a 30-day exponential, and a 20-day exponential. I like to use the exponentials in the longer-term ones because they'll turn a little faster, but I like to see a true representation of price. And this occurs in all time frames, from a 5 minutes Forex chart all the way up to a weekly or even a monthly chart in the indices. And again, predicting the indices is tough. It's a lot tougher than individual issues. But if you look for bow ties in the indices off of all-time highs or major lows, and you go back, I know my people who know me are sick of me showing this chart because I show it forever. I mean, I show it all the time. But if you look back at 99, and then if you look back at 2007, we had major sell signals. And after those two signals, obviously the market dropped tremendously. And a weekly buy signal, in the S&P 500. I call this a bow tie because it kind of looks like a bow tie when they all come together and spread out quickly. And you can see that was a significant buy signal in 2003. In 2009, the signal was a little late to the party, but the market more than doubled after that signal. And we had a plethora of signals, buy signals on the daily chart. Now, getting back to the S&P 500, the reason I showed you those historical moves is because you probably shouldn't completely ignore this signal. And this signal is going to be in effect until this market starts making, or unless I should say this market starts making new highs. So I still think we're pretty fragile here. Even if you didn't know anything about markets, you can look at things on a net basis and go back to last Thanksgiving. I'm glad, Jim, I'm glad you brought up the Russell because I almost forgot about it. But great point on that. And if you back the Russell way out, I mean, obviously we had a daily sell signal back in July, and the market has dropped significantly since then. But you can go all the way back to 2013 and see that we really haven't made a whole lot of forward progress in a long time. So no matter how many oscillators you want to plot or whatever form of technical analysis you use, never forget to just look at the chart. And I'm sure Neil does a lot of this with the point and figure charts, is look at where the chart is now and then look back at history and see where it was and just look at the net change. So again, we have that weekly sell signal in place, and then it's funny, every question this week leads back to my free reports, but I do have a free report on the bow ties if you're interested in the pattern, or you could certainly just email me directly, and I'll be happy to send you that. Okay, so that's market direction. Neil, did we get you? Dean already answered the question of the week. Let's go back to you, Neil. What? Let me get back to it once again. What asset type, and it could be stocks or Forex or options, whatever type of assets you want, do you think is the easiest to trade profitably, and why do you think it's the easiest?
I think if you're looking at stocks, you have to see if there's a commodity behind the stock, so oil stocks, copper stocks, steel stocks, stocks like that. If you're trading those, you have to look at the commodity itself, because I think the commodity itself is easier to chart than the stocks, because there's no CEO, no earnings report, and then the stock will lead the commodity, depending how that commodity is moving. So the commodity is down really far, the stock's going to be down a lot more, but then if the commodity sort of consolidates for a while, momentum starts picking up, when things rebound, that stock is going to rebound way more than the commodity price. So I think the commodity is easier to chart than the stock, and but I prefer mostly to trade the stocks based on the commodity prices. Um, and if we're looking at stocks, you have to track the S&P 500. I mean, everybody does. Doesn't matter what you do, because 80% of stocks are going to follow the S&P 500. And every once in a while, you're going to find, a diamond in the rough, so to speak, that sort of trades independently of the entire market just because they have something really awesome going on. But really what I've been focusing on for 10 years, I mean, even now, we have puts on Exxon. We got in 2 weeks, or almost 2 weeks ago now, and they've worked out great. So, I mean, I trade commodities basically all the time, but the commodity stocks. And
Gotcha.
yeah, since 2003. So.
Cool, Jim. I think I know the answer, but with Option Professor in your website name. But let's. What asset class do you think is? Do you think it's easiest to trade profitably, and why do you think is the easiest?
Well, the first thing with Option Professor is they don't get in the prediction business. Again, I'm providing content for their DVDs on that. So, if you want to have a limited risk position, you can buy an option and buy a put or call, play either direction, and you can do combination strategies. And there are a number of other tactics that are out there. The key, obviously, is to understand the use and the risk of every tactic. And once you do, you can use these options for a large variety of purposes, and the key is to understand the use and the risk of all of them, and to make sure that the strategy you're working with would be a strategy that you're looking to use at that time. A lot of people, I think, did you guys hear anything about stop losses being taken off the table at the New York Stock Exchange?
No.
I had read somewhere, and that's why I was trying to verify it with you guys if you had read it, that the New York Stock Exchange came out and said they're not accepting stop loss any more orders. So I'd be interested to see if that's a true statement or just that was false information I was reading. Because of the situation like in August where it drops way down and people get stopped out and then it goes back up. You know what I'm trying to say?
Well, the market makers can see your stops, and they'll hunt your stops, man, and they'll take you out.
Yeah.
Yeah. Well, I mean,
They'll
that's again one of the reasons why they might have either dialed it back, scaled it back, or eliminated it as a tool.
Well, on the NASDAQ, there are no actual stops, from my understanding, but your broker holds that for you, and then executes it when it gets hit. So maybe that's what they're backing off to.
Yeah, they're saying don't keep it as a resting order down there because it exacerbates drops or exacerbates advances.
That's ridiculous. Well,
yeah. But I mean, I had read that.
I believe it, and I got it from a book that I don't remember the book having a big impact on me, but I borrowed the term from I think it was Trading Chaos or something, and he used the term airbag. So I think there are cases where I would rather have my airbag hit and deployed and get me out just in case, and I might live to fight another day. I'm not going to be happy about it, but at least I'm out of the market.
Right.
In a situation
but the
like
point
that.
I was making is that in lieu of stop loss, people might use limited risk puts as some kind of defensive device. And then in certain market environments, obviously you could have all the defense you want, but you'll still sustain significant losses during certain environments, no matter what you're trying to do.
Yeah, I hear you.
Okay, I put limits on my stops for all my readers, so and it's very rare we'll get a gap down below that limit. So I think if you put in a naked stop, you're really looking for trouble, especially if you're swing trading, because every once in a while, every year or two, that stop will get hunted by the market makers right at the open, and boom, you're getting out of the stock 20% down on the day. Next thing you know, the stock rallies the whole 20% back. I've seen it. It's just a terrible situation.
Yeah,
so. I think that's where this whole to-do about stop losses on the New York Stock Exchange originated. But I just was wondering if anybody heard it being a fact or just fiction or whatever.
Yeah, and somebody said, I see a lot of things go through like chat when I do a webinar on passing, and I saw like no stop losses. What's that? And I had no idea. So, we'll have to flesh that out and see what's going on there. I think that you have to use stops. You have to have a point where you get out, but I also think that if you are a little bit more experienced, you can make that more of a mental stop. And when you get, let's say, a big opening gap reversal or something, you could go in and use a little discretion. And if the market immediately reverses and you're getting screwed by the market maker, then you could just sit back and then put that stop back in once you hit a major reversal of the market. But I think if you're newer to trading, I think you're much better off just honoring your stop. And if you get hunted out, you get hunted out, lick your wounds and move on. It's a lot better than, I'll have people call me up and say, Dave, what should I do with this stock you recommended? And I have no idea what stock it is. And it's like, yeah, you recommended it 6 months ago. It's like, well, that stock, it stopped out 6 months ago, and they're still holding on. So I would rather get stopped out at a loss than hold the stock through a 50 to 60% or more loss. Before I forget, let me answer the question of the week. I am a stock guy. I've done a little bit of everything throughout my career. I still will trade other markets, but I just prefer stocks because there is an inefficiency in stocks that you don't find in other markets, or you have to be at least more selective. For instance, I just said the S&P 500. I'm talking about the weekly bow tie on that. I think that's something to pay attention to. But that market is a lot more efficient. Efficient meaning there's a lot of people trading it. There's hedgers. There's buy and hold people. There's indexers, and all these people tend to cancel each other out. It tends to make for a choppy market. Whereas I like Neil's term, the diamond in the rough. That's my whole goal. And we've been pretty lucky so far this year, knock on wood, up until at least recently, in finding a lot of the diamonds in the rough. The market is going pretty much sideways, and we've been able to find stocks that have made some decent moves. Not everyone was obviously a winner, but we found quite a few this year in spite of the sideways market. So I definitely think that stocks being more inefficient or a better market to trade. And then I hate to keep selling you free reports, which I don't know what I'm going to do with all the money I make, but once again, I got a free report just on the. It reminds me of the old internet model. Just give away everything for free, but make it up in volume. But I do have a free report based on why I trade inefficient markets and why you should trade more volatile markets, which is just the opposite of what some people might suggest. Again, that's what makes the market. Everybody has a different way or a different style, but I would much prefer to dig through 2,000 or 3,000 stocks every night to look for that diamond in the rough. And then, coming into today, we didn't have one stock that was worth trading, at least from my perspective. So we didn't have any trades, any new trades to put on today. And that's just the way it works. I think that if you work hard, for me, it's like going on a treasure hunt every night. I'm getting ready to get a big cup of coffee out and start going through a few thousand stocks, and hopefully I'll find something for tomorrow. But if I don't, there's always tomorrow, and then eventually I'll find that inefficient stock that could make a move much larger than the overall market. So, in a nutshell, along with the answer, stocks for me. Dean, let's go back to you. I think we got everybody's question on there. Dean, it's been a while since you answered that question. Is there anything else you want to chime in? And if not, any closing thoughts or anything else you want to tell us about your trading or followmetrades.com?
Maybe I'll just show another quick chart if I can.
Yeah, absolutely.
Yeah, let me. I know we're getting a little short on time, so let me pull one up here.
No, we got time.
Okay.
Hey guys, can you?
Yeah.
Yeah, we can hear you.
Oh, okay. I just I did some research here real fast, and I found that a couple articles saying that on February 26th, the NYSE is no longer going to accept stop orders or good till cancel orders.
Oh wow.
No, good. What's wrong with good till cancel?
That's weird.
Well, somebody in this day and age, somebody's gonna find fault with anything and blame the blame the NYSE. So it's probably just CMA on their part.
That is
NYSE owned by Euronext, and who's really controlling it? Is it Europeans?
Oh, interesting. Huh. Okay, Dean, did you get your chart up?
Yeah. I hope that's sharing. Hope folks
we can see it. Looks good.
Okay, so this is Southwest Airlines. This is a trade. This is a classic Elliott Wave 5. I don't know if you can see my cursor or not, but we topped out Wave 3 in about January of this year. A retracement down into the Fibonacci retracement zone in July, and then using Dow theory, proof that Wave 5 was underway. So we got in mid-October, 40.57. It's up at 49.58. We've already moved our stop. So I use stops religiously. Whether you leave the stop open or it's just a line on the chart, I think using my method, my risk control method, got to trade with stops, and the trend will tell me when it's over, and we'll get out. We'll trail our stop up. We got a target right now of 52.92. So that one's my typical trades are lasting about 4 to 6 weeks. So that one's about done. This is
I like what you
UTX.
said about let the market tell you when the trend is over with, and that's one thing that I preach when I talk about psychology a lot, is that make as many decisions, passive ones, as you can by, as you just said, let that stop get taken out, and that tells you when the trend's over, as opposed to sitting there every day trying to think whether or not you should get in or out. That'll make you crazy. But if you have a stop and a plan in place, that's beautiful.
Yeah, and I do one-on-one coaching through Traders Coach, and
Cool.
That's what I teach. You got to have a game plan before you put the trade on. Otherwise,
Absolutely.
It's emotional, right? Then you just follow your program, right? Follow your rules.
Right, and the problem with that is most people, I think, I did some serious thinking about this a while back, and I think the reason most people don't have a plan and just wing it is because the moment you put a plan in place, you admit that you could be wrong in the next trade that you take, and a lot of people just don't want to admit going in they could be wrong. I know in every trade I have a pretty good chance of being wrong, and then I'm going to just go ahead and have a stop in place just in case. If I get stopped out, so what? I'll find something else. But yeah, good point on that, Dean.
Yeah, and yeah, that's a psychology thing. I agree, right? You have to be willing for each trade to lose, and I use a strict risk management. The distance from my entry to my stop is what determines the position size. I'm only willing to lose 2%.
That's how I do it too.
That's exactly what I do too. Yeah, good point, Neil. I agree 100%. And that's why a lot of people, going back to trading at efficiencies in markets, and that's why I like the more volatile stocks, because they have demonstrated that they can move. And something bad could even happen in a non-volatile stock, but I'd rather trade a volatile stock and adjust my share size accordingly because I had that wider stop, then trade a bunch more shares in a less volatile stock, and then you're not immune to the black swan event, even though I think volatility can be a farce sometime, and it's just the opposite. But yeah, absolutely, depending on where that stop is, that's going to dictate how big the position is. I fully agree with that. We don't have enough controversy in these shows. That's one of the complaints, but I'm in full agreement with both of you guys on that.
Yeah. So here's a new trade.
Term. Put 5,000 into every pick. Let's see. Read the news. Hold on.
I like the fixed trade size, guys. Yeah. Here's the UTX. We just went short on this a couple days ago, and I use this red line is my stop. The cyan line is my entry, and my target's down here. This green line. So I think this is a beautiful Elliott wave. Wave 3 topped out in September, pulled back up into a perfect retracement late October, and now Wave 5 down's underway. So UTX, we're short and already in profit. And an expensive stock like this, I publish specs so people would just trade it with, just buy a put, go long on a put, have enough time on it, and let's leave it run. Again, most of my trades 4 to 6 weeks, and let the market tell you when the trend is over, and it'll do that.
One thing I've found, regardless of the methodology, because I'm a big trend guy, is that everything works better with trends. So are you using some sort of trend filter in with your wave analysis?
Yeah, you can see I've got the applied reality trading software from Traders Coach here. So this oscillator here and this trend filter down here, they help me with my wave count and my trend confirmation.
Gotcha.
Yeah. So this is called the optimum wave locator, precision trend filter. And these are pyramid trading points that identify support and resistance levels. And then I just apply Elliott wave and Dow theory. So I'm not giving anything free away today. I think David's got a link. I got a special on my stock pick subscriptions, 40% off if people are interested.
Cool.
We're in some good ones, man. Doing good.
Awesome.
Can you explain the optimum wave locator? What is that?
It's really showing the momentum, the magnitude of the different waves. So you can see the oscillator is deepest on this stock on UTX back in August. It's saying that was the most dramatic price move. On this chart you can see that, but sometimes it's a little harder, so it uses both price and volume to come up with a momentum, and you can just see relative to other times that's the strongest price move.
Is that proprietary?
Yeah, it's from TradersCoach.com.
All right.
And it's a part of what's called the applied reality trading software.
Okay.
I see on the chart when it reversed. Is that sort of where they took out the novice traders and the stops, kind of where an average trader would have a stop there, and then it just rebounds, like at the very lowest point at the 85.48?
I think there's so many different traders using so many different tools and techniques and approaches that I don't think I could just say that's where the novices got taken out, right? So I would have got taken out here at this level, if you can see my cursor, because that's when the downtrend really proved it was over, was a new higher high, and that lower low lower high pattern was broken.
Oh, I see. Yeah.
Okay. But that that would have been a nice trend. I would have got in up here, at what 120 and get out down here at 94. I'll take that trade every day.
So you're getting out on the first buy signal, really. So that would
really.
like
I'm getting out when that downtrend is confirmed that it is over.
Like a breakout, like any type of breakout.
I'm really looking for 3 data points. I want a new high, a higher low, and then a new high, and that new high will take me out on a downtrend.
Okay. Yeah.
Cool. All right, Neil, any closing thoughts? Anything else you want to tell us about yourself, your trading, or TradeReview.net? And thanks again for those tips on that stock charts. That was pretty cool. So I'm looking forward to playing around with that.
Cool. Well, I think everything is about the interest rates. We never talked about it, and it looks like they're finally going to do it. What do you guys think?
I think if
They
they don't,
actually
it would
seem
be very interesting.
Kind of serious this
reversal.
time. I mean, they're even talking about, hey, I'm really looking forward to this interest rate hike. I mean, they were sort of saying
That's
that
the
sort of
stupidest
stuff
thing ever.
before,
Yeah.
but now it actually seems like they're pretty much going to do it, and it's all showing up in the charts. And I just wanted to bring up bond.
I think it's a done deal. And really the question now is their forward-looking statement? What would the rate of change be? Beyond the first move.
Yeah, because if it's a quarter point and then they piddle around for a whole another year before they do a quarter point.
Yeah, that's already built in. Who cares, right?
Yeah, I think they painted, I try to avoid all this as much as possible, but I think they've painted, I don't know, at what point in time, I say this often in the shows, but at what point in time did the Fed go from being fiscally responsible to let's just step on the gas and see how high we can make stocks go?
Exactly.
I remember years ago in the late 80s and 90s, you would be like, come on, Fed, give us something, and they throw you like a little crumb. And then they stepped on the gas in more recent years, and they haven't let it off. So that's kind of interesting the way they're running their ship over there, or whatever you want to call it. What's kind of fascinating, just a side note on the interesting, the utilities and REITs went nuts last week, and they were all over the place. And I just found that kind of interesting, so it looks like they were sort of predicting something, but the first move looked like it was a false move there, just an FYI. So if you get a chance, I know we're running a little late now, but check out those charts. I think that's kind of fascinating deal that happened last week. But yeah, any other closing thoughts, Neil? I don't know if I cut you off or not again.
The dollar is the place to be once again. As of today, avoid all commodities.
You want to be long or short?
Absolutely short.
Short the dollar, okay.
Oil? No. You want to be long the dollar. You want to be short.
You want to be long the dollar. Okay. Even with the gap down and all, or the recent little slide here?
Well, the dollar is real strong compared to all the commodity currencies.
I got you.
Amazingly, gold stocks have been doing okay, and the Swiss franc is sort of tied to gold stocks, and the Swiss franc has been doing okay, but the Swiss economy Switzerland's the best country in the world. I mean, the currency is the best, everything is run the best, and they're never at war, so they're obviously very prosperous. But the Swiss franc, that's a tough one. But basically, long the dollar, stay out of stocks, unless you have a couple of diamonds in the rough, so to speak.
Yeah.
And oil can keep going down. It can go down to the high 20s easily. Remember, oil bottomed at $9 back in the late 90s. Everybody forgets about that.
Wow.
And I mean, inflation adjusted, what's that today? $20 maybe, but I still remember gas, 85 cents a gallon, and I'd get rid of the ones in my wallet. Instead of using my credit card at the pump, I'd be like, I can get rid of these ones, and I'd always go in with $9 to fill up my tank. Awesome.
So you passed a strip club on the way and just went and filled up your tank. That's good for you. Good for you, Neil.
Exactly. I saw you there, Dave.
Yeah. Hey, Jim, I forget. Did we get closing thoughts from you already?
No, I'm going to give you a couple right now.
All
2016
right, let's hear
coming
it.
up, obviously, within weeks, so I thought I'd give you a quick thing here as far as just an opinion and some thoughts, you know.
Okay.
As far as the commodity side, you got the euro, gold, oil, and grains, to just name a few of them. There's been price deflation overall going on in those areas. And the question going into 2016, are we going to accelerate to the downside with that deflation? Or, as some are contending, these are fairly sold out areas and we could get reflation. I think that's going to be the big story for next year.
Yeah, I kind of agree with this. I kind of agree with the second half of that, but
Yeah.
I'm a one day at a time kind of guy, so
Yeah,
I'm
but I
not going
mean,
to
you know,
get
it'd
up
be
and
nice to
predict
have some
anything
kind
for
of a
next year.
macro view to go along with the minor view. You know what I mean?
Yeah, I'm with you on that, though. I think that we could get that reflation coming in. I just
Yeah.
think the pendulum has swung a little too far, but
Yeah, we'll have to
hopefully,
see.
with those kind of things, what's scary is it's never just happens it always happens in a big way. That's what's kind of really scary.
Yeah, and there's some pressure points you could keep an eye on those markets if they turn. But I mean, today's price in gold is giving, I mean, on oil is certainly giving you an idea that there's still a pretty weak legs under that fighter. You know what I mean?
Gotcha.
Got hit pretty good. I just wanted to also on the stock market again with the election year coming up. I think the volatility and the back and forth could get real big this year coming up, and so it'll be probably a pretty exciting year for traders
Cool.
above that 2135 area if it can hold rather than just go make a new high and then tank from there. And then on the downside, if it really starts giving up the 2,000 mark on the S&P, the transports have had a rough time of it for over a year now. And those broad-based indexes being a little bit dodgy, it'll be very interesting to see as we get closer to the election if the wheels end up coming off the bus,
Cool.
as it has in other election years like 08 and 2000 and 1987, 88. So it'll be a very interesting year looking ahead.
Yeah.
One little thing I wanted to,
Right.
Did you say, Diff?
No, I said go ahead. I'm sorry.
Yeah, no, I was just going to say is I believe for Option Professor, David has some contact information, and there was a special bit of an offer that we wanted to shoot out there. Option Professor has supported a nonprofit 501c3 called the Danan Project, and these guys are volunteers who go down to places like Ethiopia and Peru and Mongolia, and they give medical care, potable water, but essentially their motto is self-reliant through sustainable long-term solutions. So they're basically trying to help the needy help themselves, and Option Professor feels pretty good about that. So those who are listening who might want to help that organization, Option Professor is giving a free set of DVDs for each and every person who supports the organization at the $500 level. So by helping the organization, you get 7 option DVDs. They're 5.5 hours of material. So you help yourself and you're helping these people as well. So we just wanted to get that out there for the Danan Project, and also for those that are interested in helping and taking advantage of this free DVD offer for those that donate. David has contact information, so they should just contact us, the Option Professor, through David.
Cool, good stuff. God bless them for doing that. Good. It sounds like they're doing really good work.
Oh, yeah.
I'm going to go ahead and close it up quickly, just because we're going along here. I think you need to keep an eye out for new highs in the market, and not get too excited until we make new highs and stay there. I think follow-through is going to be key. This market is one of many fake-outs. We had a volatility fake-out last week, and that's kind of unwinding in a bit of a crazy way. I think you have to be very careful now. Just pick your spots carefully. I get a lot of questions about dead money, and they worry about being in a stock that's not moving, and if your stop is not hit, I believe, just stay with it. But more importantly, I'm getting questions about sitting in cash, and there's nothing wrong with sitting in cash waiting for opportunities. I know we get paid to trade, but sometimes you just have to wait for opportunities, and I think that's a secret to trading. And if anything, right now, I think you need to wait for gold to bottom out. Energy's going down to new lows. You might have to wait for those guys to bottom out, like Neil says. Might be a while on that. Metals and mining overall beginning to bottom out, but it's too soon to rush in and trade these markets. So just take things one day at a time. Do not get too bullish unless, again, the S&P makes the new highs and stays there, and staying there is going to be key. Okay, Dave Kosmitter, I'll turn it back over to you. Great show today. Really enjoyed you three guys. Great content, great input. I got a lot of notes here. I'm looking forward to doing a little research on them, so I appreciate you guys being here. I know David Cosmitter feels the same. So, David, thank you for having me back again, and thanks to Timing Research for having me back. Back to you, David.
Yeah, thanks, guys. Great show. Just want to remind everyone watching, you can go to TimingResearch.com/reports to download this or any past report there. Also, you can go next weekend, go to TimingResearch.com/current survey, and you can fill out the next survey before the next report on Sunday. So I just want to thank my guests again, Dean Jenkins of FollowMeTrades.com, your first time on the show, so thanks for taking the time to join us. Neil Batho of TraderReview.com, and Jim Kenny of OptionProfessor.com. Thanks, guys, for being on again. And, of course, Dave Landry of DaveLandry.com. Thanks for coming back and hosting again.
Thanks again.
So, all right. Thanks, guys.
Thank you.
Thanks.